Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday, 3rd of October, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, China's stock market rally. Is this time different, or is this just the latest in a long line of boom and bust? But first, Group Chief Economist Neil Shearing joins me for some stock taking on another week in global macro. Hi Neil, how's it going?
Hi David, all good. How are you?
Yep, I'm raring to go. Ordinarily, we would be talking about US September payrolls. It's the first Friday of the month after all. You'd be telling me what the data mean for the US outlook and for Fed policy. But the federal government has been shut down. That means no BLS releases until Democrats and Republicans can come to some kind of agreement. This is the fifth shutdown this century. It is a big political story, but what about the US macro implications?
Well, I think the first point to say is that you're right, it's a big political story, but actually, when we look at recent history and the recent history of shutdowns, there's not much of an economic impact, actually. Both sides, of course, will like to talk up the potential economic impact and pin the blame on one another. But take a look back at the US economy over the past 5 years, you would not say that the key driver of US economic growth has been, from year to year, has been the effect of these shutdowns, nor would you say that there's been a particularly lasting impact from the shutdowns either. So I suspect that the economic impact overall over the course of this year as a whole, for example, is going to be pretty small. There'll be some hit to consumption this month, but then typically because pay is made up through back pay, we'll get a rebound in consumption in future months. And so, provided we get some resolution, I don't expect there to be a significant or lasting economic impact. Perhaps the biggest impact, as you suggest, might be that we don't get any of the official data from the BLS. And of course, this is a critical juncture that we find ourselves at as it relates to not just the economic outlook, but also what the Fed does in response, how the Fed responds. And clearly, big reason for the rate cut last month was a concern the labour market was cooling. We've seen this evidence of a slowdown in hiring, question marks as to the degree to which that was counteracted by a weakness in the supply side of the labour force. But we had a rate cut nonetheless, and future rate cuts will depend upon the extent to which this deterioration in the labour market continues and to which demand for labour weakens more than the supply of labour. The supply, of course, being hit by these immigration curves. So in some senses, perhaps the biggest economic impact is going to come from the fact that the Fed is kind of flying blind a bit at the moment. And of course, the Fed's flying blind, then so are markets.
You talked about the labour market just now. I mean, what's happening there? One of the big stories coming out of this shutdown is this rhetoric from the White House, from Donald Trump, saying that shutting down the government gives them scope to do things they couldn't otherwise have done, particularly with regards to the size of the federal workforce. He's talking about having meetings with Russell Vought, the OMB director, the architect of this Project 2025 plan to remake the US government, essentially shrink the size of the federal workforce. Is there a risk that, what had been looking like a shaky labour market already could be made worse by the firing of thousands of federal workers?
Yes, clearly there is a risk, but don't forget we've been here before with Doge, haven't we? Lots of fears that would precipitate a collapse in the labour market, and those fears were generally overdone. Now, this is not to say that taking a slash and burn approach to the federal government workforce is a good thing or a good idea. It's more to say that I think the numbers that we're talking about may not necessarily have a material impact on the US economy. With that said, this all comes, as I say, at a critical juncture. The labour market is slowing, both private sector hiring, particularly outside strong sectors like healthcare, is weak. Yes, Trump might sense a political opportunity here to shrink the government. From a macro perspective, I would suggest that now is perhaps not the best time to be doing so. from a cyclical perspective, because there is some signs that labour demand is weakening. Of course, we had that ADP number this week showing a contraction in payrolls on the ADP measure in September. Wouldn't read too much into that. The survey doesn't have a great history, certainly doesn't tend to correlate very strongly with payrolls numbers. But again, it feeds this narrative that labour demand is cooling. And I guess one important point in all of this is that if we're removing the official GDP data from calendar releases over the coming weeks, then the Fed and other policymakers are going to have to rely on non-official private sources of data. And very often those are not, although they give us an early lead on what might be happening, they're not quite as robust as the official sources. So again, another problem thrown to the mix.
You talked about weakening demand in the labour market. How does that feed into the broader US macro picture?
I think the really interesting point, take a step back here. We've just published our latest round of outlooks. I was going through them earlier this week, and we've just published the global economic outlook over the past day or so. One of the big pictures that emerges when you read across what's happening across major, both advanced economies and emerging economies, is that in the US, there is clear evidence that labour conditions are cooling and labour demand is cooling. However, when we look at our GDP nowcast, for example, for Q3, that's tracking at about 0.9% Q on Q for Q3, close to 4% Q on Q annualized for GDP growth in Q3. So we've had this slowdown in hiring, but GDP growth seems to be holding up extremely well, close to 4% Q on Q annualized. So what's going on? Well, of course, the flip side of lower employment growth, but GDP growth being strong, must be that productivity growth is picking up. And there are measures, some of the monthly measures of productivity growth, such as on the non-financial business sector, are close to kind of 3.5% year on year now in terms of productivity growth. And that might just simply be because firms are kind of sweating workers and capital a bit harder, working them a bit harder. But there also seems to be something going on under the hood too. So if you look at what's happening in investment across major advanced economies, we have had some incredibly strong numbers for private investment in the US. So investment in hardware, IT hardware growing at 20% year on year, investment in IT software growing at more than 10% year on year, business investment growth extremely strong over the first half of this year and into Q3. In contrast, investment in the Eurozone, extremely weak. So you ask about kind of what's happening in the US economy. I think the defining feature at the moment is that, yes, we've got this slowdown in the labour market, and that's what the Fed is focused on for good reasons. But we've also got alongside that a boom in investment, and particularly seems to be around IT hardware, IT software, perhaps the first signs of an AI boom that is not present in other economies. And that's what's helping to support the strength of the US economy.
Just to be clear, because you talked about that investment in hardware, in software, you mentioned this boom in AI. At the moment, the AI narrative, I mean, is still very much an investment boom. It's driven the stock market to record levels, so there's a wealth effect around that. But, you know, for every study that says AI is helping workers do more, I can show you one that says that companies are still sitting around trying to figure out what this technology is and how it's going to help their business. So when will we get a clearer sign that actually what is happening with US productivity growth is all about AI and that it is transforming business?
I hate to disappoint you, but I don't think that we necessarily will. I mean, I think productivity is one of those things that we know is incredibly important component of economic growth. And Krugman famously said that it's not everything, but in the long run, it's almost everything. It's true, but it's also an economic variable that moves in mysterious ways. We don't have a good grasp of what drives it in the short term, and then we tend to argue about what has driven it in the long term when we have some evidence of it shifting. So most obviously, the computer revolution in the 1980s, 1990s took a long time famously to feed through into productivity growth in the US. And then there's been some debate as to whether the pickup in productivity growth that we did see in the late 1990s was really due to this ICT revolution. That's still kind of the subject and source of debate in academic circles. So I think if the question is when we're going to see the effects of this AI boom and productivity statistics, it's not going to be the kind of 1st of April 2027. It's going to be, I suspect, by the end of this decade, we'll be able to look back over the past 5 years and say, well, countries where we saw greater adoption of AI and AI technologies and the diffusion of that technology, and firms were better able to adapt, or generally they've experienced faster productivity growth. Here are a bucket of countries, of which I'm sure the US will be one, where that has happened. And here's a bucket of countries, probably containing some of those in Europe, where it's not happened, and productivity growth, surprise, surprise, has been weaker. So I think it's going to be slightly more qualitative than quantitative, in us being able to point to either a particular date or a data point that says, the AI revolution's here, is having an impact on productivity.
So what we're seeing now, something's happening clearly, but
something is definitely happening. So sometimes you have to use Occam's razor, right? The simplest explanation is the best one. The US is massively outperforming the Eurozone and other advanced economies. Is doing so despite the fact that we've seen a marked slowdown in hiring, and despite the fact that immigration curbs have curtailed the labor supply in the US. And of course, tariffs, we've been fixated on tariffs for the last 6 months or so. They're not the big deal that a lot of people had anticipated, but they're still a good policy. So the US is outperforming despite all of those things, and is coming alongside this investment boom that, yes, everyone's focused on what it's doing to the stock market, but in the real economy, we're seeing it play out in the investment numbers on things like, as I was saying, hardware, software, business investment more generally. So something is definitely happening. There's an open question as to how sustainable that is, how long it can last. But if it does last, and in our forecast, we're anticipating that it will cool a little bit, but investment growth in the US is still running at kind of 4 to 5% in 2026, 2027. Then the US, I think, will continue to outperform Europe.
It's not just US outperformance, though, is it? It's European, actually the rest of the world's underperformance to some degree. That Global Economic Outlook report we put out this week, I mean, it was striking, I thought, in how it frames US growth in terms of what's happening there versus what's happening elsewhere in the world. Why are we still in the state of US exceptionalism, European underperformance? How is it that this narrative still holds sway when we're thinking about the global outlook?
Just on Europe, you wind the clock back 6 months. We were talking on this podcast, I'm sure, about this idea that the era of US exceptionalism was over. Trump was in the White House. Tariffs were going to come. At that point, we hadn't had Liberation Day, but we were anticipating a substantial increase in tariffs. And of course, we had the kind of bellicose rhetoric and so on and so forth. And alongside that, we had German fiscal relaxation and stimulus and defense spending going up, et cetera, et cetera. And it fed this narrative that Europe is back. And in fact, I think von der Leyen even said this at the end of January. Europe's back. We had a fiscal pivot in Germany. That was going to reinvigorate growth, not only in Germany, but in the rest of the Eurozone too. And as you say, that's not happened. Now, why is that the case? Well, I think some of it was it was always misplaced optimism. Dare I say it, we suggested that was the case at the time. And just on Germany's fiscal pivots, a lot of the benefits of that fiscal shift we anticipated would come next year rather than this year. And indeed, developments since then, we wrote a note in the past week suggesting that actually most of the fiscal support is now going to happen in the second half of next year and into 2027. So there's some delays in even that fiscal support coming through. And when it does come through, the multipliers will be quite low. Most of Germany's problems are structural in nature and aren't easily fixed by demand stimulus. And that gets us to the key point, I think, is that a lot of the problems in Europe in particular, but advanced economies more generally, they're structural in nature. Then this is not necessarily about a weakness of demand. This is not 2010, where the private sector's on its back, the banks are deleveraging, demand is weak. It's kind of obvious what you need to do. You just need to reflate demand somehow. These are problems on the supply side. Most economies are at full employment, so it's supply side weakness. And it's about the weakness of productivity. As we just said, the drivers of productivity notoriously uncertain. In the case of Europe, high energy costs don't help, low investment rates don't help, the structural decline of long-standing industries don't help, and China has shifted from being an important source of export demand for countries like Germany to a growing competitive threat, a growing source of competitive pressure. So put all that together, it doesn't really surprise me that Europe's continuing to struggle.
This narrative around US exceptionalism, I mean, is not by any stretch new, is it? in the past, there's been this tendency to talk about the global economy flying on one engine. I think Larry Summers used that phrase many, many years ago. Are we back in that situation now, looking at 2026? And if so, what are the risks around that?
I think the big risk for the US is that, as I say, this AI boom, investment boom proves to be fleeting, and therefore you get a confluence of immigration curbs starting to bite on the labor side, the investment boom coming off on the capital side, and this productivity renaissance that appears to be in its early stages fades. That pulls down GDP growth, real income growth, consumption growth. That's the kind of big risk over the next couple of years, added to a kind of more general feedback loop through the labor market of weaker hiring, feeding weakening demand in the real economy, feeding weaker hiring still, and you get this element of reflexivity in the labor market that leads to a vicious cycle. So that's the risk for the US economy. But you're right that for the global economy, that has enormous consequences. Now, this is the point that really drives me to despair with economists, is that when you ask, okay, what's the driver of global economic growth? They'll look at in a mechanical arithmetic sense at the economy that is contributing most units of kind of GDP to global GDP. In the past, that's been China. Now, I think it's just about India is contributing the kind of most units of GDP to GDP growth in our forecasts. But of course, that ignores the interaction through the global system between different economies. And it's still the US that's the consumer of last resort. So if you look at global imports, it's still the US that is responsible for about just under 10% of global imports. So if the US consumer weakens, US imports weaken, so GDP everywhere weakens. So all of these points have feedback loops. And if the US economy slows because the AI boom slows, and then for the US consumer slows because US real incomes slow, then that will feed through into weaker growth in the rest of the world, despite the fact that in a mechanical arithmetic sense, the US is no longer adding the most units of GDP to global GDP growth each year.
Neil Shearing there on US outperformance and the global economy flying on that one engine. There is a lot more to say on the policy implications of our 2026 global outlook, and we will get into that more next week. In the meantime, check out the Global Economic Outlook report that Neil and I talked about. I will link to that in the podcast notes, along with a page that houses all of our latest Outlook reports from across our coverage areas. This past week, our UK and Europe teams were answering client questions about the outlook for their respective economies in drop-ins, which are our short-form online briefings. In the coming week, look out for similar sessions on what we expect to happen to the US and Chinese economies through the end of this year and into 26. I will link to both of those sessions in the podcast notes. And remember, clients of CE Essential and Advanced, which are our all-access packages, get invites to all of our drop-in sessions. If you're not already a Capital Economics client and want to check these events out, get in touch at sales@capitaleconomics.com and we can get you access. Neil also mentioned that note on Germany's fiscal pivot. I will link to that. And also on AI's potential impact on productivity growth. We've got a whole body of work about this, which I will link to, including our proprietary AI Economic Impact Index, which ranks countries by their ability to develop, diffuse, and adapt to this technology. Now, Neil and I talked about how AI hype has been fueling a US stock market boom. Well, it's been a similar story in China this year. The Shanghai Composite Index is up 19% so far. Hong Kong's Hang Seng Index done even better. That's up nearly 40%. And they compare with the S&P 500's 14% gain so far. It's been a stunning run for Chinese stocks and an auspicious one in that this year is the 10th anniversary of a devastating Chinese stock market boom and bust. As markets closed for China's National Day holiday, I caught up with Tom Mathews, our head of Asia-Pacific markets coverage, to find out whether what's been going on with Chinese equities is sustainable. And I started by asking about what's been driving the market higher.
I think there's a couple of things going on. The first is AI and a reassessment of China's role in the global AI race. So part of that is just, I guess, hype about the potential success of Chinese AI models and the use that Chinese companies are making of this AI technology as well. We saw that, for example, around the market reaction to DeepSeek. But I think there's a broader question here of how the authorities see the private sector role, the private sector's role in China in the AI race. I think there was a case a couple of years ago that they were maybe a bit skeptical that the private sector had an important role to play in achieving some of their strategic aims in these technological fields. But there's really been a policy shift, at least as far as investors are concerned, towards a more constructive role for the private sector. And I think you could see that in a lot of their communications this year and frankly last year as well. It's clear that the authorities have learned from things like the success of DeepSeek and now see the private sector as playing a big role in helping them achieve their strategic ambitions. I think for now, investors are interpreting that as being pretty positive for the net present value of those stocks. Whether that actually turns out to be true remains to be seen. I think we've seen some strategic sectors in China that have great technological success but don't necessarily return a lot of capital to shareholders. But for now, the investors are definitely taking it positively. Having said all that, it's not just about tech, it's not just all about AI. We have seen more broadly a turnaround in corporate earnings in China. It's this famous fact that corporate earnings, or the EPS of the MSCI China index, for example, basically hadn't grown in about a decade. But it does seem to have turned around a bit over the past 12 months or so. And that's really been actually fairly broad-based. A lot of sectors where earnings were contracting, even outside the tech sectors, they're now flat. Maybe they're even slightly positive year on year. So I think that broader story of a recovery in the earnings growth of some of these listed companies has helped not just the tech sectors, but the broader market as well. And we have seen the broader market do pretty well at times too.
Doesn't sound like a traditional Chinese stock market boom, does it? You look back in history and so much of these boom bust cycles in the market have been driven by government reform hopes, government stimulus, government direct encouragement of households and businesses to invest in the market. Is that different this time around?
A little bit. I mean, I wouldn't totally downplay the role that the government's had here. So around this time last year, we did see some efforts to try and to redirect funds essentially into the stock market. Remember, maybe a year and a half ago, I think there was the stock market rescue package. And of course, there have been subsequent moves. Now, a lot of that, to be fair, was actually focused on the bond market and the regulators trying to get money out of the bond market. They felt like as though bonds had rallied unsustainably, that yields were unnecessarily low, that there was potentially a bubble in the bond market they were trying to prick. But I think a side effect of that was that a lot of this money that was being invested in bonds actually got redirected towards equities. So even if they weren't trying to pump up the market, arguably, it's had that effect a little bit. But I think the second thing is, as I've said, although maybe most of the rally isn't about them trying to direct funds directly into the stock market, I think the policy shift that we've seen over the past couple of years towards the private sector has definitely contributed. And I think that's come alongside a backdrop of them, to be honest, a couple of years ago being concerned about how poorly the stock market was going as well. So I do think that probably did form part of their more constructive attitude that they've taken over the past couple of years.
You mentioned the role that the signs of recovery in earnings is playing here, but the broader backdrop of the Chinese economy is a pretty weak one, isn't it? Consumer confidence really hasn't recovered since the pandemic. Deflation is this persistent threat. The government does appear to be trying to take steps now to deal with that, but nonetheless. And just looking at our China activity proxy, so our proprietary measure of what's going on in the economy, and that's saying that the more upbeat government read of the economy versus our CAP, the China activity proxy, is the biggest on record. The CAP is showing that activity is actually pretty weak. The government story is that actually, no, we're nearer the 5% growth target. So how do you square the circle between buoyancy in the stock market and broad macro weakness?
Yeah, it's a great question. And people often say, the stock market isn't the economy. But if you look actually at growth in earnings per share of listed companies, in the past, it has actually tracked our CAP fairly well, at least directionally. When the economy is accelerating, it tends to be the case that listed companies' earnings accelerate as well. And similarly, when things are starting to turn south. And really, at the moment, those two things are diverging. We're seeing listed companies' earnings pick up a little bit. Whereas we know, as you've said, that the broader Chinese economy, things aren't so rosy. I think there's probably a couple of things going on. One part of the Chinese economy that we know is doing very well is the export sector. And exporters maybe are arguably a bit overrepresented on listed companies, certainly on some indices. But second, there's probably a bit of a compositional thing going on as well. So the big tech companies in China are certainly doing fine as far as profitability is concerned, and they're probably a lot bigger on the stock market these days than they are in the real economy. Well, in fact, they certainly are. And on the other side of the ledger, the real estate sector, of course, famously not making any money at all. That's a much bigger share of economic activity more broadly than it is of, let's say, the market cap of the MSCI China Index, which is basically negligible these days. So I think that's probably helps to explain it. But yeah, you're right. It is an interesting divergence because we are actually seeing from a stock market point of view that earnings per share are picking up. Now, that doesn't explain the entire rally. Valuations, say price to earnings ratios have increased as well. But I do think this turnaround in listed company earnings that has happened at the same time as the economy has decelerated is a big part of that. And it's certainly an interesting divergence.
We're 10 years after the 2015, the great bubble, and then the great bubble bursting in the Chinese stock market. And to some extent, we're still living with the fallout from that experience, the reorientation of government policy. How do we know that history is not going to repeat itself? Households, businesses piling into the market, inflating valuations until the inevitable crash. Do you see parallels between what's happening now and 2015? Are there any dangers, in other words, that investors need to be watching for?
Yeah, I think there are a few red flags. I mean, arguably a big part of that 2015 rally, as you alluded to, was the role of directing household savings into the stock market. Authorities very much encouraging people to invest in stocks, which of course then gave them a vested interest in stocks continuing to go up, and it continued to feed on itself for a while and ultimately until it couldn't anymore. And, we don't have great data on what exactly households are doing with their funds, but we certainly know they're unlikely to be investing in property at the moment. And we've seen the PBOC does survey some households on questions such as what do you think is a good thing to invest your money in at the moment? And the share of households saying that they think stocks are a good investment has increased quite sharply over this year. So, maybe there's signs that stocks are starting to become more attractive to households. I've also seen at times, especially in the more recent part of this rally over the past couple of months, onshore equities are doing particularly well. Those are the ones listed in the mainland that Chinese households have much easier access to. So again, a bit of a red flag. And I think the other thing that has attracted a lot of attention, including of the regulators, is the pickup in margin lending. So that was, of course, a big driver of the 2015 rally. This huge increase in margin lending, again, sort of associated with a speculative activity by retail investors or by the more speculative investors. And the stock of margin lending is now as high as it was at the peak of 2015. Now, having said all that and set up that case, I don't think there is a bubble in the stock market in anywhere near like there was in 2015. I don't think people should be quite as concerned as they were or should have been back then. Yes, it's true that valuations have increased, but they were very, very low. And they're really starting to get, especially compared to valuations elsewhere, we can talk about more about this perhaps later, they're starting to get a bit more normal. Margin lending, yes, it is much higher, but the stock market itself is much larger than it was in 2015. If you were to scale it by market cap, really it's flatlined over the past sort of 5 years or so. And another big thing that happened in 2015 that hasn't happened now was this huge rise in the premium. There's companies that are listed both in the mainland and Hong Kong. Their shares in the mainland rose very, very sharply relative to those in the Hong Kong. And that was a sign that money was flowing into those mainland markets and pushing up the value of the shares well beyond their fundamental levels. And again, that's not something we're seeing anywhere near as concerningly this time around. Overall, I understand that, there's a bit of concern about how fast the rally's gone. But I think if you take a step back and look at this list of things carefully, I don't think any of those things are flashing red or giving us warning signs just yet.
So you think this rally has legs? What's your expectations heading into 2026?
Yeah, I think it does. Now, there's one perhaps bigger headwind that we haven't talked about. It's not the valuation of the stock market, but just the economic gravity of it. We talked about the divergence between listed companies' earnings and the broader economy, but you look back at history and that's really lasted for too long. That would be unusual. So, wouldn't be surprised if listed company earnings did start to fade alongside the economy, certainly over the medium term. I think that's a headwind. Having said that, tech companies' earnings are doing just fine. In fact, by some measures, at some times they've been doing almost as well as, for example, US tech companies, which is a very high bar to clear. So they're certainly making plenty of money. And, although valuations have increased, if you compare them to, for example, their US counterparts, you compare them to global companies, they don't look especially high. And in fact, if anything, they arguably look low. I think part of that is investors have just taken a long time to be persuaded by this policy shift that the authorities have done. So, I mentioned that they really started that shift, almost 2 years ago now. The stock market rescue package, the various constructive things they were saying about the private sector, trying to unwind some of the negative perceptions that they arguably had created themselves due to their previous private sector crackdowns. But it just took investors a long time to come around to that point of view, having been burned in the past, having been perhaps let down by short-term rallies that turned around once it became clear that the authorities weren't totally clear about the policy shift. I think now investors are starting to see that they are serious about this shift, and that's probably partly what's supporting the more recent rally. Is they're sort of, again, genuinely demonstrating the credibility about that policy shift, and that's continuing to help those valuations recover. Look at them, I think there's still a bit further for them to go on that front, so we wouldn't be surprised if China's stock market continued to do fairly well over the next, say, 6 to 18 months. I mean, we'll put out our outlook within the next week or so, and and that would probably forecast China to be just about one of the best performing stock markets in the world, perhaps behind the US, maybe behind Taiwan, those other sort of big tech AI sectors. But other than that, I think that that's the company that we'd expect China's stock market to be in over the next year or so.
That was Tom Mathews on the China stock market outlook. Tom will be joining the China team for that drop-in this Thursday, so it's an opportunity to put your questions to him and find out more about this weak macro strong equities discrepancy. Again, check the podcast notes for the registration details of that event and contact us at sales@capitaleconomics.com if you're not already a Capital Economics client and want access to all of our analysis and to our events. But that's it for this week. Maybe the US government reopens in the coming week and we get that payrolls data to talk about on our next episode. Maybe this all drags on. Either way, we will be back next Friday with more on the global macro markets outlook. Until then, goodbye